Welcome to this explainer. Today, we're diving right into the wildly volatile USD/JPY currency market to uncover the technical rules that are literally hiding in plain sight. At first glance, right, the FX market looks completely terrifying. You've got sudden government interventions, ruthless institutional algorithms. The sheer scale of the swings is enough to make anyone sweat. But what if there's a secret decoder ring for all this chaos? What if, right beneath the panic and the screaming headlines, there's actually a highly structured mathematical rhythm just waiting to be read? So here's our roadmap for today. We're going to start by exploring the perfect order phenomenon. Then we'll look at mastering Elliott waves and figure out how to actually survive massive market interventions. After that, we'll talk about beating those pesky algorithms, and finally, we'll lock in a winning trading psychology. Basically, we're systematically breaking down the frameworks that let disciplined traders find predictable, repeating patterns right in the middle of all that noise. All right, let's dive right into our first topic, the perfect order phenomenon. Right now, a condition known as a perfect order has actually been confirmed for the USD/JPY pair. But what does that actually mean for us? Well, it's a super rare market condition where multiple timeframes align perfectly in the exact same trend direction. Simply put, every single fractal piece of the chart is pointing straight up. There's zero conflict between what the market is doing today and what it's doing this entire month. You can think of this kind of like nested matryoshka dolls. You've got your 1-hour chart trend, the 4-hour, the daily, the weekly, going all the way up to the monthly chart trend. When those snappy little hourly movements nest flawlessly into a massive, undeniable macro trend, boom, you have a perfect order. For a technical trader, it is absolutely the strongest foundational signal you can ask for. It confirms that momentum is universally synchronized. So we know the trend is up. Now, let's move on and talk about measuring that trend by mastering Elliott waves. The upward trend isn't just a straight line. It breaks down into 3 specific steps based on Elliott wave theory. First up, we get the initial breakout, which is wave 1. Then comes the shallow pullback, or wave 2. And finally, the really fun part, the explosive surge, known as wave 3. Identifying a strong, clear wave 1 sets the stage so you can anticipate that highly profitable wave 3. But here's the million-dollar question. How do you know if wave 2 is just a quick, shallow pullback or a total trend reversal? Well, the exact number you need to be watching is 38.2%. Over a decade of statistical analysis backs this up as the ideal Fibonacci pullback limit for wave 2. If the market pulls back but stops dead right around this 38.2% mark, it proves that massive, strong buying momentum is still intact. The buyers haven't given up at all. They're just catching their breath before the next push. And that brings us to a very precise mathematical target, 1.618. You see, once that wave 2 pullback finishes up, wave 3 often extends to exactly 1.618 times the size of wave 1. This is huge because it gives you a precise mathematical goal rather than just guessing. You're not trading on hope, you're operating on a calculated expectation value that tells you exactly where the trend is highly likely to go. Okay, but how do these beautiful mathematical waves survive sudden, massive government actions? Let's get into surviving market interventions. The USD/JPY isn't just a playground for retail traders, it is a literal battleground for central banks. We saw heavy-handed government interventions back in 2022, and then a second massive one in January 2024. And looking ahead, we're expecting resistance tests going into 2025 and 2026. These interventions violently drop the price in an instant. It creates absolute temporary panic across the entire market. But here is the core takeaway you need to remember. Interventions are heavy-handed, sure, but they are temporary disruptions. The technical truth always resumes. While central bank actions cause immediate, staggering drops, the underlying technical trend, especially when you're in a perfect order, is just so incredibly strong that it eventually absorbs the shock. The market essentially looks at the intervention as a flash sale, buys up the newly discounted currency, and the technical truth resumes its upward march. Now, beyond governments, there's another hidden threat out there we need to talk about: beating the algorithms. The modern FX market is a battlefield where retail traders and institutional algorithms operate on entirely different rulebooks. And frankly, if you don't know the rules the machines are playing by, you are going to get swept away. The divide here is pretty stark. Retail traders usually trade on emotion and fear, while algorithms operate strictly on mathematical levels. Take chart wicks or shadows, for example, those long, thin lines extending above or below a candle body. A retail trader sees that, panics, and abandons their position. But the algorithm actually creates those wicks intentionally. They're hunting the stop losses of emotional retail traders. The retail trader gets distracted by all the market noise, but the pro or the algorithm completely ignores it and just patiently waits for their mathematical setup to trigger. So, to survive algorithms hunting your stop losses and governments dropping surprise interventions, we absolutely have to upgrade our mindset. Let's talk about winning trading psychology. The absolute key to survival here is emotionless execution. You have to form clear rules and enter your trades mechanically. And here is a huge tip. Once you're 20 pips in profit, move your stop loss right up to your entry point. Boom, you've just created a completely risk-free trade. If a sudden government intervention strikes out of absolutely nowhere, the worst thing that happens is you break even. Remember, never regret taking a profit too early, and truly accept that the chart has all the answers. The golden rule is simply this: when the shape appears, trade mechanically. By waiting patiently for the perfect technical setup, like that pristine 38.2% Wave 2 pullback we talked about, trading stops being this terrifying, stressful gamble and transforms into a disciplined superpower. You don't have to guess what the news is going to be. You just have to recognize the shape on the screen. Ultimately, it all boils down to this: the charts hold all the answers. Order truly does exist within the chaos of global currencies, relentless algorithms, and giant interventions. You just have to step back, strip away your emotions, and read the underlying data. So, now that you understand the mechanics of the perfect order, the mathematical targets of Elliott waves, and the trap-setting behavior of those institutional algorithms, what patterns are you going to spot next? What hidden rules will you decode in the charts tomorrow?